It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And Heidi Ho, it's the man himself. The podcast is named for Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. Back in town after a little Euro trip, a little early summer vacation.
You guys are going crazy. I mean, you guys work so hard. Every time I talk with you, you are either in Austin or San Antonio or all these different places that you guys are looking at properties all over the great state of Texas. And so every once in a while you have to take a vacation because you don't spend enough time with your beautiful family. So I'm happy that you took a vacation over to Europe. How was that?
It was definitely a trip, not a vacation. I mean, we saw a whole lot of stuff and, a bunch of places I've never been before. So learned I don't speak English very good and certainly don't speak French or Greek either. So I learned that the hard way.
That's good. I mean, a great educational trip, and I'm sure that the whole family enjoyed it. So good for you guys. Hey, listen, talking about trips and someplace to come to see us at the Old Capital Conference starting October 4th and 5th in 2023, October 4th and 5th in Dallas. Again, this is the conference that you want to go to. We do it every year. We always try to change different and fun locations. This is going to be the Frontiers of Flight Museum. It's connected to Dallas Love Field. And Michael, talk a little bit about your impression of the Old Capital Conference. Is it worthwhile to go to? Who should go to it? Tell us a little bit about what your thoughts are there.
Yeah, I think last year you guys had around 500 or so of our closest friends out there. And, what I like about this conference, or what's a little different about this conference compared to some of the others, these are people actually in the business doing deals. Lots of, general partners and limited partners, but people actually in the business doing deals. And, you have not only on the investor side, but you have actually a lot of the brokers and the kind of the kingmakers out there that are, selling and representing the ownership groups are all across the state of Texas really come there. So if you want to, get connected with one of the brokers in town that sell a lot of deals, virtually all the teams are represented in some form or fashion out there. So this is a way to get in the room with people actually, transacting, doing deals, and, people that are selling and lending on it as well. So, it's a very high level conference and, very, very actionable as well.
Yeah, we're not trying to sell you anything. We don't have any books, tapes, videos on what is out there. What a lot of people try to do. We just want to bring everything by getting the multifamily, and you want to fast forward your education and talk with some people that are in the business. Go to the oldcapitalconference.com, oldcapitalconference.com, and hopefully we'll see you sometime towards the fall. So again, in Ask Mike Mondays, as you know, Michael is a former banker, worked for one of the largest banks in the United States. He ran their commercial real estate group here in the Southwest, did a fantastic job. And sometimes he got kicked in the head so many times that he said, I don't want to be a loaner anymore. I want to be an owner. So he felt he was on the wrong side of the equation. And so a number of years ago, he went over to the ownership side. So Michael shares some great words of wisdom about what he's experienced the last, he's been doing it for almost 25 years. Unbelievable. Great job. But Michael, when he moved over to the ownership side, he bought a lot of Class C properties and is transitioned over to Class A- properties. And he can talk a little bit about that. But Michael, question for today is, what are you seeing out there? What's going on? We're here at the middle of June of 2023. What's your sense of where the market is? Is it a good time to come back in? What's going on out there, Michael?
Paul, I'm actually starting to get pretty bullish here, over the majority of 21, the first couple months of 2023, we were net sellers. We sold a whole bunch of properties coming in 2023. Just delivered a ton of capital back. We had a couple that closed earlier this year. We had a couple that generated some 1031 exchanges. So we closed on one back about 2 months or so ago as we record this podcast, and then we have another one that's closing into June, which kind of upleg a 1031. So we had to do a little kind of small pass a hat to kind of make up the delta on the cash unit close. So felt pretty good about that. And then now we're starting to see, especially specifically in the kind of Class A and A- space, so kind of 20 years or younger, let's call it from a vintage standpoint, starting to see some opportunities. There you hear all these headlines about, some of these large privately traded REITs needing to generate some liquidity to cover some redemptions. The most kind of in the headlines are like the B REIT the Blackstone, having to gate the redemptions for the last 9 or 10 months or whatever has been now. They're out there selling quite a few deals and they're needing to meet the market. Market's definitely down from the peak. You're seeing these deals transact at 20, 25% kind of off the peak price of early 22, kind of like the peak of the peak. And I think we're starting to see some pretty attractive levels coming in. We had a little moment in time where rates were down and the indexes have kind of ticked up here over the last 4 to 6 weeks, let's call it, as we record this in mid-June. And again, today's FOMC meeting, and we expect the first pause or skip or whatever they're gonna kind of characterize the meeting today. But I think we're starting to see some capitulation of some of the more institutional owners and some of the merchant developers where they have to sell. You merchant developer, you build a deal, you got a bridge loan, a construction loan, you got to sell. And that's what we're starting kind of seeing transact. What I'm not seeing transact in any sort of large quantity is kind of the workforce housing, which is more where you finance, Paul. So I still think there's some more room to come in the workforce housing because you haven't seen a lot of volume. But in the Class A and A minus, you're starting to see some deals trade and starting to see some pretty attractive valuations, to be honest with you.
Well, give me some examples here, because I really tend to agree with you that on the B minus, C plus, C properties, again, these are workforce housing. This is the people that work in your car, cut your hair, are assistants at the school to teach your kids. This is the workforce. This is the people that actually do all the hard labor in life. And so they live in these properties. They do a great job, but you haven't seen the knife fall all the way down. You don't think the capitulation is there yet. And I don't either. I think it's not going to be there for another 6 months or even possibly a year. I think we're going to go down much more farther in these levels. But to flip it over to the Class A properties, you think that it's kind of capitulated. Can you give me some examples of maybe some properties that you've seen or you've looked at in terms of maybe 2 years ago or last year or so, the people at and what they're going, similar properties in the area are going for?
Yeah, without naming names here, but we're about to, we just got awarded a deal. We're working to get into escrow as we record it in the greater Austin area. It's a building built in 2010, give or take, and so it's 12, 13 years old at this point, so kind of a A minus, but it's been renovated by the seller. And we're getting this deal, let's do that math here, about 20 to 25%, kind of below where the comps were at the peak of late 21 into Q4 21 or Q1 of 2022, those deals that were set. So we're seeing materially lower pricing. Now Austin got a little frothy with a lot of these deals trading kind of plus minus 3 cap handles, and now the market's probably let's call it a 4.5 to 4.75 cap. And this deal we're buying on a trailing basis, tax adjusted, is closer to a 5 cap. So I think we're getting a relative value right now, just with the situation specifically. But the cap rates certainly have expanded from nosebleed levels in the kind of 3 cap range in Austin at the absolute peak to now your high 4s. And I think Dallas is kind of that high 4s at kind of 4 3/4 on your kind of Class A minus kind of product. That's what you're seeing. And with a little bit of rent growth, in your year one projections, you're certainly north of a 5, and most of these cases kind of in the mid 5 cap range is what most buyers are performing today. Where in Dallas Fort Worth didn't get quite as crazy as Austin, but it's certainly down there pretty low with the 3 handle on it at the actual peak. So that's what you're seeing. I think we're hopefully at peak rates here, certainly for the short run. And if today's a pause, and that's kind of confirmed that it's a actual pause in July with the FOMC meeting in July, then I think as our friend JP Conklin talks about, we should start seeing rate cap costs come in, probably in that August-September range, which would be a welcome relief. And maybe the front end of the curve starts getting priced in some rate cuts because those will come sooner and sooner. My personal crystal ball thinks there's something going to happen in September that's going to make rates kind of come in by, September, give or take. That's what I think is going to happen. And, some of these deals might have a little bit of light at the end of the tunnel. So I'm starting to see the pricing, get to pretty attractive levels below replacement cost. where we were above replacement cost for the better part of 2 years, let's call it, kind of leading into recently. So I'm starting to see some opportunity. Obviously there might be some level of issues with rent growth and collections and things you got to kind of think through and be strategic about, but starting to see that opportunity in Class A. And I still believe, like you, I think there's going to be quite a bit of opportunity in the workforce housing. It just hasn't manifested yet, but there's, gravity's got to set in at some point with someone that's over levered and have, cash flow issues and rate cap expiring or maturity coming up, and the banks are frozen and they, decides to an agency loan is going to wipe out all the equity that's in place and then need some more cash in. So I think at some point there'll be some capitulation. I don't know if that's in Q4 this year or we're going to need 2024 for some capitulation in the workforce housing. But I, personally feeling pretty optimistic, and we have a deal, like I said, that we're working on right now. And, if anyone's not on our database, I want to get in our database and see this opportunity coming up, I would just encourage you to go to our website, which is www.spiadvisor.com. It's SPI-advisor.com. And there's a contact form. You can kind of fill that out. And if you're a credit investor, we can get you in the database and send you kind of future opportunities. So enough of my shameless plug, but I'm starting to get bullish.
That is a shameless plug, Mr. Michael Becker, but that's okay. We understand that. I know you have the passion and want to make sure everybody is exposed to what you're talking about, just to give them some ideas about what's available out there. Let's talk about bigger picture. I mean, apartments as an asset class. I mean, we've all seen the foreclosure that was heard around the world recently in Houston, that big 4-property portfolio that went south, and I don't know, what's your 2 cents and going forward for somebody to invest in apartments? I know you're going to be a little bit biased, and so would I, but I want to kind of get an idea of, if anybody's pushed back and said, I'm just going to keep my money in something else. Why are people investing in apartments still these days?
I mean, listen, if you're buying in a high growth market like the Texas markets are, and you got population immigration and fundamentals are still really strong, I mean, it's a cyclical business, and we just didn't see a cycle for the better part of 12 years, Paul. I mean, we're kind of basically straight up for 10 to 12 years, and that shouldn't be the case. There should have been a cycle at some point in the middle, and so the longer the run, maybe this will be a little more of a correction, but long run, I mean, I think in 5 years from now, there'll be certainly much higher pricing and higher rents than what they are today. And, if we can get the expense kind of controlled, which I think hopefully we're at peak insurance and tax bumps, hopefully it can't get much worse than what they are, certainly on taxes, property taxes, that is. And I think that, you're going to look up in a few years if you're buying in a high growth area. These values are going to be higher and the rents are going to be higher, and it's a moment in time. And I think there's some dislocation that you should come in and try to take advantage of, and I think that we're starting to see gravity as we go back and listen to however many hundreds of episodes we've done. You can probably hear the theme that you and I talked about, how it just didn't make any sense for the 1970s and 60 vintage assets to trade at the same or similar cap rates to some brand new construction. And that was the case for the better part of 2 to 3 years. Really, they divide gravity a lot longer than I thought it would. And I think we're seeing gravity kind of come in, and the cap rates are expanding, generally speaking, or have expanded generally speaking, and they're a lot stickier on the Class A, and they're less sticky on the 1960s deals in Houston that are kind of in the hood with chillers and boilers and flat roofs and kind of the inferior construction product. Those are a lot riskier assets, and you're starting to see that risk get priced back in where gravity got defied for too long. And that's why you mentioned at the beginning, we started in workforce housing and traded our way up. And as there's opportunity back in workforce housing, we'll probably go back and buy some more of that at some point. But I think reality's got to kind of sink in a little bit more before there's an attractive entry point in that type of product, in my humble opinion. But right. I don't have to answer your question, Paul, but I mean, I think they're just the fundamentals that are coming at it are strong. And if you could work through the capital market issues, which hopefully we are, about to start seeing some improvement in, I think you have a great entry point right now to be fine. But I mean, a deal that you bought, as long as you didn't massively overpay and have a terrible capital structure in 2021, I think by 5 years later in 2025 or 2026, I mean, I think that you'll have, higher pricing than what you paid in 2021 if you're in a pretty strong market.
Yeah, and the reason why I asked this question is that a lot of people think that all properties, all apartments are all the same, but really it's bifurcated. I mean, it's all different pieces. I mean, you have older assets that were built in the 50s, 60s, and 70s. They may be flat roofs, two pipe chillers, and we don't want to confuse those properties that are in central business districts with maybe suburban properties that were built maybe in the 80s and 90s, and then go a little farther out to the properties that were built in the 2000s, 2010, 2020, fairly new properties that are individually HVAC'd, better, higher quality assets, better technology in these properties. So we can't throw when we say investing in multifamily, I think we have to define when we're talking with clients, and I mean, not just the sponsors, but I'm talking about investors that want to invest in your deal. If you are a deal sponsor, you got to define exactly what the heck you are going to invest in. And today, I think buying higher quality assets that are newer assets that are in better areas that have better technology is probably the way that you want to do it. I mean, we've been banging the table on that for a number of years. There's nothing wrong with workforce housing. Everyone needs a place to stay and live and create their family and do that stuff. But as investors, we want to really kind of figure out is that if we're going to be here for the longer run, we want to have a property that's not going to need immediate maintenance and repairs all the time with like some of these older properties do in these more demographically challenged areas. And so, I think when you talk to possible investors, you want to define what stuff that you want to buy. What else are you seeing out there, Michael? What are some of the more positive things in the market that you're seeing?
I think like I said, I started to see the opportunity. Right now, I think we're starting to see occupancy increase. That's we're seasonally at a pretty good time in the market. So I think we're starting to see kind of fundamentals firm up from an occupancy standpoint, which will hopefully help continue rental growth to drive northward. And again, this is coming from a guy that owns a bunch of properties in Texas. I don't own a San Francisco or some of these maybe more challenged locations. So I'm sure this is very geographically specific for what I'm seeing. But I'm starting to see that kind of firm up, and occupancy's ticking up. So I think the demand is still there. Obviously, we're going to have some supply come the rest of 2023 and throughout kind of 2024 in the Sunbelt markets and the markets I participate in. There's going to be quite a bit of supply, but I think looking forward, there's going to be a hole in supply in 2025 and 2026 because it's like next to impossible to get deal capitalized right now if you're a developer. I mean, there's virtually no construction lending and equities being very very selective. So there's going to be a big lack of supply in 2025 and 2026 because those deals that should have been started beginning of this year or right now that take 18 to 24 months to deliver just aren't going to get going. So not saying we're not going to have a little bit of supply overhang for the next 12 to 18 months, but if you can take the approach of I'm buying something below current replacement costs at a good location at 25% off peak pricing, and I could get debt to get me out 5, 7, 10 years, and then I think 2025, 2026 will be one hell of a year for rent growth. I mean, it just makes sense to me that that's coming. So the older I get now that I'm in my mid 40s, these years go by a little bit quicker, and 2025, 2026 is going to be no time. I mean, COVID was almost 3.5 years ago when that first hit, and I can't believe it's been that long from when we were kind of talking about from our houses about whether we could go outside again or not, and think about that. I mean, that's 3.5 years from now. I mean, we're almost to the beginning of 2027. So I mean, that's just a snap of the finger. So I think those that have courage, and hopefully we'll have enough to take advantage of this opportunity right now, because you don't know exactly when the bottom or the capitulation is going to be. But I think it's close enough right now in the good markets that I think we should be starting to get aggressive and ramp that up over time. So I'm starting to get pretty optimistic, Paul. And we're near the backside of this. I mean, we had to refinance several deals. I'm just about to we just got to sign up a deal this week as well on a refinance of one of our San Antonio assets. So then I got 2 more refinances I got to get done and kind of have my problems behind me. And, honestly found that process wasn't as terrible as I thought it was going to be. We're going to have to cash in a little bit on this refinance, but it really wasn't that bad. And we had a cash neutral option, just had a more expensive option. And we took a pretty low cost option and have to cash in a little bit because we thought that was a better solution, not to bear the deal basis.
You're paying down the balance of the loan. So you're just putting a little bit more money into the transaction. It's not getting eaten up with fees and costs and things like that. You're just reducing your exposure and putting the property in a better position with less debt on the deal, correct?
And it saves a ton in upfront costs, legal costs, origination fees. The spread is materially lower on the loan, and then it's got flexible exit on the prepay. And if they start slashing and burning rates, like I think is going to happen, we have a lot of optionality to refinance. A year or 2 years down the road again and get a better position or sell it or whatever we want to do. So, thinking through the refi transaction we're just about to consummate. I mean, really, it was we kind of had option A, option B, just kind of talking in real time here. Option A was a higher octane loan with higher upfront costs, higher transaction cost, higher rate cap costs, all those things that would take, but we'd probably be cash neutral, but would add 5 to 6% to our cost basis and be cash neutral. Or we could take do a little cash call and not add so much to our basis, that to reduce the debt, a much lower, cost up front as well as ongoing, expenses, and make it not be so stressful from a debt coverage ratio standpoint, and not add to the basis really. So that was kind of the calculus we did, Paul, and felt that we were in a position that made a lot of sense, and that's what we're going to go with. So, it's not the sky's falling, but they were talking about having a good asset with a good experienced sponsor and a good location, because that asset was built in 2019. So it was, a much different situation versus, 70s deal down in Guns Point in Houston, right? I mean, it's a little different with an IT guy that's been in business for 5 minutes. So, a little different situation.
A little different portfolio. Any place that's called Guns Point is not a place that I want to put my hard-earned money into.
Yeah.
Somebody that's a brand.
So, I mean, I think it's just a matter of, if you're evaluating deals and sponsors and looking for it, I mean, all these deals are not equal. And I think that was lost in the marketplace for the better part of a couple, 3 years there. And that's starting to kind of come home now. So, it's not all rosy. It's not like perfect out there. And we've had to suspend some distributions on a few deals, and we're about to do a small cash in refi, which isn't, overly terrible. It's not that much money on a percentage basis. And, we're going to live to fight another day and survive till 2025. And that deal is going to be worth a hell of a lot more than we paid for it a few years down the road. I'm convinced of that. And, it is what it is. And people don't participate. We're going to put the money in and get the deal done. So that's it. And starting to get aggressive. And I would encourage those with their back clean to start thinking about trying to get aggressive. And, maybe it's a little early on the workforce housing, but I don't think it's that far off. We got to be relatively close within 6, 12 months to start to see some capitulation and some real opportunity.
Sounds good. Again, if people don't know what the heck you do, Michael, again, what does SPI do? And what does SPI stand for? And if they wanted to get more information, how do they get a hold of you?
Yeah, the best way to get more information is just go to our website, which is spiadvisory.com. And what we're focused on this year, Paul, is really just finding high quality opportunities to put out, syndicate, raise capital, do deals, take advantage of some of this dislocation. Some of the sellers that right now more on the institutional and merchant developer side, where they have to sell because they have a maturity or they got a redemption in their private REIT where they need to get these deals out. That's where we're seeing opportunity in the present time. And then I think as we get later in the year and into next year, I think we'll kind of be like Marty McFly and go back in time and kind of buy some of these older deals, and hopefully have some outsized returns when the fundamentals make a little more sense. And I think we get ahead of with the rates are a little higher. I mean, the only thing you really can't change is your purchase price or the location. Everything else you can always change your financing on it down the road. So if you're buying something when the treasury rates are in the 4s and the treasury rates go to the 2s, you can always refinance it or sell it and replace your debt at some point in time. So those are things we're thinking about. So yeah, if you want to get more information or get into our database, because we are about to have an upcoming opportunity that we're pretty excited about, let's go to our website, sbiadvisory.com, the contact form. We're taking accredited investors in, and we'll make sure we put these opportunities in front of you.
Sounds like a plan, Mr. Michael Becker, better known as Marty McFly, going back in time to buy some of these nice, beautiful properties at maybe some lower prices. So thank you, Mr. Michael Becker. We appreciate it. Again, I'm Paul Peebles. Have a great day.